Welcome to the Explainer. Listen, I am absolutely thrilled to have you here today. If you're the kind of focused learner who just wants to cut through all the financial noise and get straight to the facts, well, you're in exactly the right place. Today, we're taking a really enthusiastic, highly structured deep dive into the ARS Core Equity Portfolio ETF, which you probably know better by its ticker symbol, ACEP. We're going to unpack exactly what this asset is, how it actually ticks, and most importantly, because I know so many of you are here specifically for this, we are going to show you exactly how to buy ACEP shares. So get ready, because we're going to take this complex financial instrument and make it crystal clear. Okay, so here is our roadmap for today. 1. Understanding ETFs. 2. Investment strategy. 3. Inside the portfolio. 4. Versus competition. 5. Evaluating risks. And 6. How to buy ACE. Let's kick things off right away with Section 1, Understanding ETFs. Basically, what exactly is ACV? So the absolutely crucial thing to remember here is that an ETF gives you this bundled exposure to multiple assets. It's kind of like holding a whole basket of different stocks. But, and here's the kicker, it trades on a standard stock exchange as easily and fluidly as just buying a single company's stock. It prices continuously throughout the day, completely unlike your traditional mutual funds. You want to buy it, sell it, or even short it during normal trading hours? You can completely do that. Now, check out this number. Over $97 million. This represents ACEUP's total assets under management, or AUM, based on our source data. Now, 97 million sounds like a massive pile of money, right? But in the broader market, it actually gives us a really good sense of its current scale. It's a relatively young fund, remember, having just launched in late November of 2025. Let's rapidly hit the baseline Fox here. It's issued by ARS. It is a large blend equity fund that's currently holding just 38 specific positions, very tight. It offers a modest 0.11% dividend yield, and at the time of our data capture, it was trading right around the $19.91 mark. So, to sum that up, it's lean, it's highly targeted, and it is heavily focused on a very specific slice of the market. Moving right along to Section 2, Investment Strategy, we're talking top-down and bottom-up. This quote is pulled straight from the ETF's prospectus, and honestly, it tells us everything we need to know about their core philosophy. ARS Investment Partners relies heavily on active management. They aren't just setting this on autopilot and blindly following some passive index like the S&P 500. No way. Instead, a dedicated management team is actively utilizing fundamental research to manually identify companies that they believe are currently mispriced and have strong expected growth. Their strategy is actually a really fascinating two-pronged approach. On one side, they use a top-down macro outlook. So they're looking at the big economic weather. Where is the Federal Reserve taking interest rates? Where are global capital flows moving? Then they take all of that and combine it with strict bottom-up financial screens. That means they roll up their sleeves and dig right into the micro-level data of individual companies, hunting for strong disposable cash flow, improving margins, and reasonable price-to-earnings ratios, all with an eye toward above-average dividend yields. Okay, let's pull back the curtain for Section 3. Inside the portfolio, specifically sector and concentration.
Now, this is where it gets interesting. Despite their explicitly stated mandate of seeking above-average dividends, which, usually points investors straight toward boring utilities or consumer staples, ACP is actually heavily tilted toward the technology sector at over 31%. Technology. That's followed by financials at almost 16% and energy at roughly 15%. They're making a very specific, highly active bet on exactly where growth is coming from in today's market. And when we peek under the hood at the actual stock tickers, these top positions really reveal that tech-heavy strategy in action. They are deliberately overweighting names like Lam Research and Broadcom to capture targeted growth. But check this out. Interestingly enough, their second largest holding is actually a government obligations money market fund. That tells us they're holding a decent chunk of cash or cash equivalents, essentially keeping some dry powder ready to deploy the second they spot new opportunities. This right here highlights a major structural reality of ACEP. Nearly 40% of the entire fund's capital is concentrated in just its top 10 stock picks. Think about that. Out of the top 1,000 large U.S. companies they could potentially choose from, they've narrowed their massive conviction down to a very, very tight group. This is literally the absolute opposite of your broad, vanilla, diversified index fund. Which brings us naturally to Section 4, versus competition. Let's look at the market alternatives.
All right, let's just let the numbers do the talking here. When you buy any ETF, you pay an annual fee, which is called an expense ratio. ACP charges 45 basis points. Now, compare that to Vanguard's massive VOO fund, which charges just 3 basis points, or the dividend-focused DGRO at just 8 basis points. Plus, ACP operates with a much smaller asset base of $97 million, whereas those other mega funds are managing tens or even hundreds of billions of dollars. So, what does this all mean? The absolute crucial takeaway from this comparison is the trade-off that you are making as an investor. If you buy ACIP, you are consciously choosing to pay a higher premium for a highly concentrated, discretionary active manager who is trying to outsmart and beat the market. On the flip side, if you buy VOO, you're paying almost nothing to simply ride the pure, massive momentum of 500 of the largest companies in the US. It's a classic showdown: active, concentrated conviction versus passive, broad diversification.
All right, Section 5, evaluating risks. Because if you're going to play the game, you have to understand concentration and scale.
Let's break these risks down quickly. First up is concentration risk. Simply put, if just one or two of those top 10 holdings perform poorly, the whole fund suffers heavily because so much capital is tied up there. Second is manager risk. You are entirely reliant on the ARS team's human ability to pick winners. Third is track record. Because the fund is so new, we just don't have that crucial 3, 5, or 10-year performance data to judge them on yet. And finally, liquidity. A smaller asset base sometimes means the gap between the buy price and sell price, what we call the bid-ask spread, might be slightly wider than it would be for a massive billion-dollar fund. Independent research from Koala Gains specifically flags this reality in their report. Without any data from the brutal 2020 pandemic crash or the 2022 rate shock market downturn, retail investors just don't know exactly how this specific active strategy is going to behave under severe pressure. So honestly, you are taking a bit of a leap of faith on this manager's ability to navigate future economic storms. Okay, the moment you've been waiting for. Section 6, How to Buy ACEP, the exact execution steps. Using the investing platform public.com as our guide from the source material, the process today is incredibly streamlined for modern investors. Step 1, you just open and sign up for a brokerage account. You can literally do this right on your phone while sitting on the couch. Step 2, fund that account by securely linking your bank or doing a quick debit transfer. Step 3, simply navigate over to the Explore page, type the ticker ACEP into the search bar, and execute your buy order for whatever amount fits your plan. Step 4, once purchased, boom, it's done. You just manage it right there in your portfolio alongside all your other stocks and assets. It is really that direct. And that brings us to the final and, quite frankly, the most important question of all, and it's one that only you can answer. Does a highly concentrated, actively managed, tech-heavy dividend strategy actually align with your specific financial goals and your personal risk tolerance? Think on that. I want to thank you so much for joining me on this explainer today. Keep learning, keep analyzing the data, and I will definitely see you in the next one.